And today we invited him on to talk about the mortgage approval loan process and really what happens when you first get going all the way through underwriting to the actual closing. There's a lot of things you really should know there. So the process, the mortgage process, it can be known to be extremely tough for some buyers, and other buyers it's much more seamless. Can you walk us through that process?
Absolutely, because like you said, it can be very daunting sometimes. Other times it can feel like you're just showing up and you're closing. I mean, essentially, when you get a house under contract, I mean, obviously, you go out with your advisors. You guys are showing them houses. You get a property under contract, meaning you've already been pre-approved. And pre-approved means I've already more or less gone through all your finances and know that you qualify for this loan. So now you have a house under contract, and we start the process. First thing is completing the application. And the application, most of it is already done. We did the pre-approval. But I go back in the file, ask some questions, any changes to job employment history, maybe anything different that's happened since we first spoke. Assuming everything's consistent, then we do the application. We actually order the appraisal. We order title work. What title work is, we actually reach out to closing attorneys that we work with, and they do title. They make sure basically there's no liens on the property. There's no issues with maybe back taxes, maybe, that the property's clean, and that's our goal. So we start the process, do the application, then we get, the title work order, the appraisal order. Typically, once we start the application, it takes about 7 to 10 days for the bank to approve you. And in some of the, factors, obviously getting the appraisal back, ensuring that the value is what it is. If the house is $400,000, we have to make sure it's worth $400,000, and we have an appraisal done, which you get for your records. Also, the title work, make sure there's no issues with title, any potential concerns, or maybe old mortgages that weren't paid off, whatever it is. So then once we have that back, the loan gets approved. And as you know, one of the topics, or one of the things on the purchase and sales agreement is a commitment date. So typically when you buy a house, you have a closing date, yes, but you also have a date where the loan has to be approved. You need financing in place. So, And when that happens, I mean, Emilio, you see this a lot, right? Commitment date is very common. Obviously, it's something where we hit that date, we get a letter stating that you're approved conditionally. It's subject to certain conditions. One being, you still have a job in place. Two being that you have, the ability to make that down payment. We have the bank funds we can verify. That's a big part too. I mean, a lot of people ask me, what do I need to do? You need to show the money in your account. So that's part of the underwriting process. So, we go through all this. We get the appraisal back. We get the title work back. Everything's clean. The loan gets approved. And then when the loan gets approved, let's say after the 7 to 10 day mark, because most closings right now, we're looking at a 30-day window from start to finish. So if we get approved in the 10-day mark, then it gives us about, 2 to 3 weeks to actually close. And people say, well, why do you need, 2 or 3 weeks in between when the loan's approved versus when you actually close? Reason being is, the loan's approved, but there's usually conditions, meaning one, you have insurance in place, homeowners insurance. So that's something that buyers will have to do research on. Hey, find a company that you want to work with, or maybe the company that you have your auto insurance with. Secondly, we also have to make sure you're still employed. We do what's called a VOE, a verification of employment. We go to your employer, call them, we send a written form, making sure that what you provide us is accurate, your pay stubs, your W-2s, all that. We have the information vetted, but then we have to make sure you're still employed and the dates you gave us are accurate. Then thirdly is also, like I said, funds, looking through bank statements, making sure there's nothing out of the ordinary there. And then finally, we have to make sure that after all this is done, we do a final verification to make sure that, hey, listen, nothing has changed. Your credit score stays the same.
So, Paul, where do people get tripped up the most, do you find? What part of the process are buyers kind of either dropping the ball or getting tripped up on where they could maybe even derail the transaction?
Absolutely. Great question. So I would say the most common is one would be income. Some people, especially borrowers that maybe are self-employed in particular, they tell me what, they have I make this much money. Then all of a sudden we see tax returns, things change. Or even a borrower that maybe has a situation where they're commission or overtime. And while we see initially their W-2s from the past 2 years, or we see recent pay stubs, when we go to their employer, we ask one of the questions. This is one of those questions I always cringe a little bit. Is it likely to continue over time? Is it something likely to continue? Or commissions? Is this something you anticipate going forward? And if for some reason they say no or not likely, even if we see the income on paper, because the employer is saying it's not likely to continue, sometimes that's an issue with overtime income being used and bonus income, things of that nature. So that's a big trip up. The second area where I see potential concerns is when, people give me bank statements. Maybe I pre-approved them back in, let's say, September. Then all of a sudden we're doing a loan in November. November's bank statement shows a payment we weren't aware of or something they didn't tell us about. All of a sudden, now we're asking questions. And technically, if the numbers are tight, that monthly payment could derail the loan if it's that tight, the debt to income ratio. So those are things we always have to juggle.